The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon and welcome. Thank you all for joining us today for our August webinar on the ABCs of trusts. For those of you joining us for the first time, my name is Amanda Sylvia. I am the Client Service Associate for Stonehearth, and I've been with the firm for 4 years. My primary role includes client service, marketing, and compliance. I would like to just start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of your questions and will ask David to answer as many as time allows at the end of the webinar. If we do happen to run low on time and we're unable to get to your question, David or myself will reach out to you directly following the webinar to make sure that we do get your question answered. Now I would like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor, bringing with him over 20 years of experience in financial planning and wealth management. Prior to joining our firm, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. He also serves as a member on our firm's investment committee. David, thank you so much for joining us today.
Thank you, Amanda. Thanks very much, and good afternoon and welcome, everybody. Thank you for joining us today for our topic on trusts. Trust is a very important topic that we deal with a lot with our clients. We get many questions on this topic and felt that it was important for us to review it in one of our monthly webinars. So our goal for today is really just to give a nice overview of trusts and explain the different types of trusts that are out there and give kind of a high-level overview of trusts. So we have a lot of important information to get to with this topic, so let's jump right into it. So the things that we want to discuss today are really talking about what is a trust. The topic of trust planning can really be very complex, and each family's situation will dictate what type of trust will work best for them and whether it even makes sense to use a trust at all. So really in our time today, the goal is to provide an overview of trust and define what a trust is, discuss why someone would create a trust, and explain the differences between various types of trust. There are many different types out there. But we'll also look at whether a trust is right for you depending on your financial structure. And we'll look at how trust can be used in estate tax planning. So the main idea and takeaway for a trust is really looking at the fact that every family situation is different. So whether or not a trust might make sense for someone that you know and that you're talking to that has a trust doesn't necessarily mean it might make sense for your particular family's structure. So we'll look at those things today. And finally, we'll look at situations where you just may not need a trust. There are certainly situations where the time and expense and effort to create a trust doesn't make sense in all situations. So we'll look at those as well. So what is a trust? And a trust is an agreement that describes how assets will be managed and held for the benefit of another person. So when we look at the creation of a trust, it's typically going to include three parties. So first you have the creator of the trust. In the legal world, they call this person the settlor or the grantor or the trustor, just to make life a little more confusing. But all those terms are interchangeable for really the creator of the trust. And the second party is the trustee. And that individual is responsible for administrating and following all of the terms that have been written into the trust. And the trustee can be a person or a corporation, for example, a professional trustee. And if the trustee is a person, it can be and oftentimes is the actual creator of the trust. So the creator and the trustee can sometimes be the same person, and we oftentimes do see that. The third and final party are the beneficiaries of the trust. And this can be anyone or any entity like a charity or organization or a corporation. And oftentimes the initial beneficiary is the creator of the trust and the trustee, while the secondary beneficiary or beneficiaries could be spouse and children. And you can also see situations where family members may be beneficiaries as well as charities or other entities. So it's possible to have individuals and entities be beneficiaries within the same trust document. And depending on the type of trust being created and the goals of the person creating it, that individual will transfer assets into the trust by changing the ownership of those assets from him or herself to the trust. So this is referred to as funding the trust. And oftentimes it's referred to sometimes as funding the trust inter vivos, which is a Latin term for meaning during the creator's lifetime. So that's really the whole purpose of when someone would want to create a trust, is they're creating this during their lifetime so they can have control of how their assets are distributed beyond their lifetime. So this is a situation where a person is funding the trust that they created, and that happens by changing ownership of assets from a individual's name over to the trust. So this may be a surprise, but sometimes people actually go through the time and effort to create a trust, but forget to actually fund the trust. So funding the trust means that after the trust is created, you have to go over to your assets and look at which assets you want to actually change the title to and put into the trust. So sometimes people meet with their attorneys and they have the trust drafted, and all of that time and effort goes by, and you kind of walk away with this nice trust document. But you have to remember, step 2 is to go over and change those assets so they can be retitled to the trust. So it's important to know what the goals of the trust are and change the title on any of the assets that are going to be placed into that trust. The other situations where a trust document is created but remains unfunded until the creator passes away, at which time assets are transferred into the trust. So some trusts are created in this situation after the creator passes away, with instructions typically found within the creator's will. So in this case, these are referred to as testamentary trusts, and also known as a will trust or a trust under will. A testamentary trust is a type of trust that's created in a last will and in testament of a person. So the terms of the trust are specified in the will, and unlike a living trust, this type of testamentary trust comes into existence only after the settlor has passed away. So because the testamentary trust doesn't take effect until after the settlor dies, that person can make changes up until that point when the trust becomes irrevocable at that point after they pass away. So this type of testamentary trust is created after the will goes through probate, and the executor of the will probate the will and then create the testamentary trust in that process. So what are some reasons why someone would want to create a trust? Well, there are many, and as I said, they're really dictated on a person's individual situation. But in general, when you're looking at reasons to create a trust, they kind of boil down to a few important reasons that people kind of start with. And the main reason would be to avoid probate. So I mentioned just a moment ago about assets that pass through someone's will. A testamentary trust can be created off of that, but first the assets passing through the will are going to go through the probate process. Whereas if you create a trust during your lifetime, any assets placed into that trust are going to avoid the probate process. So that's going to be a primary driver for a lot of people as a reason to create a trust in the first place. Secondly, people might want to identify a secondary trustee who can step in and manage the assets in the trust. If the trustee becomes ill and incapacitated and unable to manage their own affairs. So a trust document can be written in such a way that even though the creator might still be living and may have been the initial trustee of that trust document, someone else can step in if that initial person can no longer manage their own affairs, and they can step in and be the trustee. So some people like to have that built-in protection. And really, another reason might be because their attorney recommended it. And I know that might not seem like a primary reason, but it's a popular response that we get from clients. So, you know, as financial advisors, we don't create trusts. Attorneys do that, but we often will review clients' trusts and look to understand what the goals of the trusts are and make sure that we're following with their financial plan to align that with whatever the goals of their trusts are. So oftentimes people will indicate that their attorney suggested the creation of a trust, and then really the goal is for us to find out the reasons why and what the trust is trying to do, whether it's just simply to avoid probate, whether it's for estate tax purposes, or maybe protecting assets from creditors or nursing homes, which we'll get into in a little bit. So one of the primary types of trusts that are out there is a revocable trust. And by far, this is really the most popular type of trust. And most people use these revocable living trusts to avoid the expense and time-consuming court-monitored probate process that we were just talking about. So property that's left in a revocable living trust passes to the beneficiaries without probate. So it's a nice way to get assets directly to beneficiaries without having to worry about the probate process. And the terms of the trusts are private, so no unauthorized persons can find out their creator's wishes or what they owned. Families also like the fact that with a revocable trust, that since it is revocable, any of the terms within the trust can be changed at any time during the creator's lifetime. So it's a big advantage of the revocable living trust. So while the grantor or settlor or creator does not receive any tax benefits from a revocable trust, the creator can withdraw funds from the trust or alter or cancel the trust at any time. So in most instances, the creator is going to report all the taxable income right on their own personal tax return. So this helps keep things simple, since there's no additional tax forms that are needed to be filed with the revocable trust. So you're not really doing a revocable trust for tax purposes, because you're really going to have those assets just pass through on your own tax return. It's really for the other reasons of avoiding probate and having privacy around your assets. But the biggest hurdle for most families is really funding the trust with all of the assets that you would normally pass through probate, as I said. So that big important second step after creating a trust is, okay, now let's look at all of our assets and decide, what do we want to put in that trust? What assets do we want to flow through and be governed by the terms of this important trust document that we just created? So it really requires time and energy to retitle accounts and assets from the creator's name to that of the revocable living trust. And it's not an overly complex task per se, but it does require some time and some patience. At our firm, we always start by looking at a family's balance sheet to identify which assets need to be retitled to be placed into the trust. So we then, just go slowly but surely through the list, and we check them off as we go through the funding process. So that step is really a critical part in any trust planning, just to make sure that we're getting the right assets to go into the trust. There's also irrevocable trust as a different type of trust that's out there. So unlike a revocable living trust, which the creator can modify, an irrevocable trust cannot be modified in almost all circumstances. There are some circumstances kind of beyond the scope of what we'll get into today, but there are very few circumstances where an irrevocable trust can be changed. So the main idea is to think of irrevocable trusts as trusts that cannot be modified. So This can be kind of a intimidating process for a lot of families to have this notion of creating a trust and not being able to modify it. And it's one of the reasons that families opt for the revocable living trust instead. However, there are situations where an irrevocable trust is a better fit to match the creator's goals and what they're doing with their financial structure. So this is particularly true if the creator is interested in asset protection strategies, which can be important in certain family circumstances. So unless specified within the trust document, assets in an irrevocable trust are not accessible to the creator after they're put into the trust. For this reason, irrevocable trusts are a valuable tool for families who want to protect assets from creditors or nursing home. Revocable living trusts do not offer that asset protection from creditors or nursing homes. So this is an important statement because many creators who have a revocable living trust are under the impression that their trust does offer that type of creditor or nursing home protection or shield around the assets, but the living trust does not. An irrevocable trust does offer that type of protection. So if there's any question about protections offered in a trust, we really advise our clients to, contact the attorney who helped to create the trust in the first place and ask him or her whether their trust offers certain types of shields or protections of assets within them. So it's really important to have a good handle on that when the trust is created, just to make sure it's following with your intended goals of creating the trust in the first place. Now, irrevocable trusts are also created when the creator of a revocable living trust passes away, since that trust becomes irrevocable upon their death. So when the creator passes away, a revocable living trust automatically becomes irrevocable at that time. And that's the whole idea, is that that person created the trust knowing that when they pass away, this trust document becomes irrevocable, and the trustee is then responsible for laying out the terms of the trust as they've been written. So the trustee will then refer to the trust document to determine whether the trust assets should be paid out immediately to the beneficiaries, or whether assets should remain in the trust until some future date that may have been spelled out in the terms of the trust. For example, trust documents typically have provisions that delay the distribution of trust assets to minor children until they reach a certain age, when they will hopefully be more mature and better prepared to inherit assets. So that's typically language that you might see in a trust, and one of the reasons why someone would use a trust in the first place, to delay that inheritance out to beneficiaries that may not be ready to handle those assets. Now, irrevocable trusts are considered a separate tax-paying entity from the individual creator. So think of them as a living, breathing person, and irrevocable trusts must file their own tax return and pay their own taxes. Some exceptions apply to that, but in general, an irrevocable trust is going to be its own tax-paying entity. So handling taxes for irrevocable trusts can be rather complex because oftentimes the assets in the trust generate income like interest and dividends and capital gains. So a decision has to be made whether that income can either be retained by the trust or paid out to income beneficiaries, such as a surviving spouse. And the trust document might have language that governs all of that behavior as far as any interest and dividends and capital gains that are generated by the trust assets. So if the income remains in the trust, then the trust is responsible for paying the tax. But if the income is paid out to the income beneficiary, then that income beneficiary picks up the tax on that. So that piece is fairly complex, but important to have a good handle on how that works, primarily because of the differences in taxation that are going to be realized between individuals or trusts. So looking at at that, as we can see by reviewing these tax rates for individuals and trusts, and it only takes, you can see in the bottom section of this table, it only takes $12,750 under the current tax brackets for trust, only $12,750 of income generated by a trust to get to the highest tax bracket for a trust. So this is much lower threshold of income than the joint or individual tax brackets, as you can see, to get to that highest rate. So you need to be up over $612,000 for joint filers and over $500,000 for single filers to get to that highest 37% tax bracket. But it only takes $12,750 to get to that of income to get to that highest bracket for a trust. So we talked a moment ago about a trust being its own tax-paying entity, but it also has its own tax brackets, as we can see in this table. So important to note that for irrevocable trusts that might be retaining trust income within them, then when that tax return is filed for the trust, it's going to have to be governed by its own tax brackets here. So it can, it can be fairly easy for income that's generated within that trust and retained in the trust to get up to that highest bracket. But as I said a moment ago, if that income generated by the assets in the trust is then pushed out to any income beneficiaries of that, then the trust won't pay taxes at the trust level. The individuals who received that income from the trust will then pick that up on their own tax return, which is going to be more favorable as far as the way the tax brackets work. So a fairly complex area involved with trust, so important to have a good handle on how that taxation works and whether income will stay within the trust to go out to the beneficiaries. So a lot of times people will get a good understanding of all these different types of trusts and the differences between them and why some people create a trust. But it really comes down to looking at, is a trust right for you? And there can be many situations where a trust is right for a person, and you don't have to necessarily look at whether all of these reasons apply to you to see if a trust is right for you. It may just be a handful of these reasons might be good enough for a trust to be the right planning tool for you. So if you want to avoid probate or plan for the management of your assets in the event that you become ill or unable to manage your own affairs, then a trust could make sense. If you want to control your assets beyond your lifetime, then a trust is a good way to do that, because the terms of the trust that you wrote when you were still living are going to be carried out by the trustee of your trust. So if you want privacy, it's another good reason to create a trust. When someone passes away, the terms of their trust remain under wraps. So probate, on the other hand, is a public process, and your will be accessible to anyone who cares to take the time to look it up versus a trust, which is completely private. So privacy is a big reason for some people to create a trust. Also, if you have property in more than one state, you run the risk of having your estate probated in each state. So one way around this would be to put your properties into a revocable living trust, also known sometimes as a realty trust when you're dealing with real estate. So it's hard enough dealing with the probate process in one state, let alone two states. That can be even more complex. So another reason would be if you have certain situations within your family dynamic, then the trust might help to smooth all of those situations out and give your family a real solid game plan to handle assets beyond your lifetime by looking at the trust documents. So there may be a lot of issues in dealing with different family dynamics as a result of second marriages or situations where families don't feel confident that maybe children, even children of any age, will be able to handle the assets that they receive. So managing that through a trust may be a better way to go. So, if you have children from a previous marriage that you want to leave assets to, but only after your current spouse has had access to them during their lifetime, there's a way to do that. So that type of trust is called a qualified terminable interest property trust, or a Q-tip trust, as you'll sometimes hear it referred to. So there's different types of trusts even within the main trust types that I talked about that can govern certain specific situations that will help. Also, if you have minor children and you want to delay their access to their inheritance beyond certain ages, if you feel that the children are too young to inherit assets at a certain time, then a trust, revocable living trust, or a testamentary trust can help. So the trust can be managed by someone reliable that you trust until your child reaches an age that you feel is more appropriate for them to receive those assets. So, but you can still give the trustee discretion to pay for their education and welfare at any age if the trustee sees fit. But the idea is you just have more control than the children just outright receiving assets as a lump sum. And if you plan to leave any of your account or assets to someone with special needs, you really should consider a trust called a special needs trust. So the assets that are owned by a special needs trust are not considered assets of the beneficiary, and they'll still preserve the ability to maintain government benefits now or in the future for that individual, if that applies to them. So there's also other reasons governed by estate taxes to create a trust, and a handful of states charge estate taxes, as well as the federal estate tax. So there are a few states that have their own estate taxes at the state level. So these states will charge an estate tax when assets pass to a non-spouse beneficiary. So our home state here of Massachusetts is one of those states. And if you pass away in Massachusetts and leave over $1 million of assets to a non-spouse beneficiary, then the state of Massachusetts will tax your estate. So tax rates range from 0 up to 16%. So it can be an expensive taxation on your estate assets as they pass through to non-spouse beneficiaries. So this tax will not only apply to the funds over $1 million, but they also apply to the first $1 million. So Massachusetts only uses the $1 million exemption to determine whether or not you will owe any estate taxes. So once it goes over $1 million, they're going all the way back to that first dollar to apply the estate tax. So if that doesn't work, then you might want to consider incorporating an estate tax sensitive trust into your estate plan. So these trusts should be given consideration if you're married and your estate, including life insurance proceeds, exceeds $1 million. So $1 million always sounds like a lot to people, but when you start to include life insurance policies and of course the value of one's real estate, then it can be easy to get up over those levels. So the federal government also charges estate taxes, but fortunately the exemption at the federal level is currently $11.4 million per person. So that's the 2019 number. That's slated to increase slightly each year. So if your estate is greater than 11.4 million, including life insurance, in most cases, and if you're married, then you really should consider a estate tax sensitive trust. But these trusts can really help to essentially double your exemption amount, allowing you and your spouse to pass on up to almost 23 million to non-spouse beneficiaries without triggering any federal estate tax. So certain types of trusts can be written solely to handle the issue of estate taxes, but the language of the trust has to be written in such a way where estate tax management was the goal of the trust. So working with the attorney who drafts the trust, that's going to be something you want to talk about to make sure that the right language is in there to govern the estate taxes, whether it's at the federal level or the state level. So that's one of the bigger reasons why someone might want to create a trust in the first place. But there are some circumstances when maybe creation of a trust does not apply to you. So they're not appropriate for everyone. In taking a look at some of the more common reasons why you might want to pass on creating a trust. Or for starters, if you don't own assets to put into a trust, then the trust won't really be effective. Trusts are only effective if they're created and have language that you want to then dictate how those assets that are placed in the trust are going to be managed. If you don't want to spend the money to create a trust, that might be a reason not to do it. Or if you're okay, if your estate does go through the probate process, then creating a trust to avoid probate might not be a reason that you're too concerned about. And if privacy is not very important to you, or you already have a durable power of attorney document that gives someone the authority to handle your financial affairs, or if and when you're unable to do so, then you might feel that that document is enough to kind of create the control that you might otherwise get in a trust document. And if you're not really concerned if your estate needs to pay estate taxes or isn't likely high enough to be at that threshold, then the trust document may not really be needed. So, and of course, if you just prefer to keep your estate plan simple, then going through the time and energy and effort to create a trust may not be right for you. So there certainly are many family circumstances where a trust may not be an effective or necessary planning tool, but for all the other reasons that we talked about and the different types of trust, there can be many good reasons to create a trust. But we want to be clear that we don't want people to feel that, oh, a trust is right for everyone, I should have one. There are certainly circumstances where it doesn't apply to all people. I want to just take a moment here to just talk about some upcoming webinars that we have. So in the next couple of months here, for September, we have a Understanding Your Medicare Benefits webinar with a guest speaker who has worked with us previously on this topic. Brian Lynch will be joining Jamie on that topic, and to help understand and get a little bit better clarity on the important topic of Medicare benefits. And then in October, my colleague Chris Gauthier will be doing our CIO's Corner webinar when he does his quarterly update. And then for the November topic, we'll be dealing with charitable donations, and we'll be looking at that webinar on Thursday, November 25th. So hard to believe that we're talking about the months of September, October, November, but here we are at the end of summer looking ahead to the fall months. So those are some of the upcoming webinars that we have, and hoping that you can join us for those as well. So I'm wrapping up the trust conversation here, and I'll turn it over to see if there's any questions from the group.
Hi, David. Yes, we do have a couple of questions. So the first one I have here is, does a living trust protect property from creditors?
Oh, that's a good question. The answer is no. A creditor, any creditor who might win, say, a lawsuit against you can go after the trust property in a living trust, just as if you still owned it in your own name. So with a revocable living trust, you're not getting that creditor protection. So, generally after your death, all the property you own, including assets held in a living trust, is subject to your, any debts that you had. So, for example, if your house is held in a trust and you pass to your children at your death, the creditor could come in and demand that they pay that debt. So you're not getting that creditor protection on a revocable living trust.
David, if somebody has a living trust, do they still need a will?
Yes, they would. So a will and a living trust are different from each other, and having one is not necessarily a substitute for both. So a will deals with any property that was not included in the living trust, and anything that was not left in your living trust or not placed in the trust then may be distributed under your will. So it is important to have both, because there'll be certain circumstances where you don't place everything you own in a trust, and then that will be handled through your will.
David, we just have a couple more here. How much can a trust save us in mass estate taxes? Can you just describe a little bit how that might affect estate taxes in general?
Yeah, so creating a trust to be estate tax sensitive, it would really depend on the size of the estate and the amount of assets to really look at how much it would save in taxes. But, you know, generally speaking, if you have an estate a little bit over $1 million and those assets, if those assets are passing to a spouse, then you're not going to have to pay any estate taxes at all. But let's say after the second spouse passes away and assets are going to children and so forth, you could be looking at into tens of thousands of dollars on estate taxes if you're up over $1 million. So creation of estate tax sensitive trusts will help to preserve that $1 million exemption for the first spouse to die, and then another $1 million for that second spouse to die, and now you're kind of passing, in some cases, up to $2 million to non-spouse beneficiaries. So, the expense of creating an estate tax-sensitive trust is usually well worth it, and you'll avoid paying taxes that were much more than what the creation of the trust was for.
David, it looks like we just have one more here. The question is, if my father passes away and leaves the assets to my stepmother, it is my understanding that my siblings and I will inherit these assets when my stepmother passes away. Is it possible that my stepmother could disinherit us as in the children?
No, in that case, it wouldn't. It would depend if that individual was just a beneficiary on an account. They could choose to not receive assets, but in the case of a trust, if that stepmother in this case was the trustee, became the trustee of the trust, they could, depending on the terms of the trust, maybe have a little more control to take less of the assets and pass assets down to the other beneficiaries. But in most cases, the terms of the trust would have to be followed, which was why the original creator created the trust in the first place, so that those terms will be carried out. So it's possible to maybe get to that point that the question describes, but we'd have to really take a look at the trust document itself to see if the language provides some discretion on the part of the trustee. So it's possible that could happen, but the trust language would have to provide that discretion in there to have some flexibility on the way those assets are transferred.
David, thank you so much for joining us today, for going over trusts with us. That was the last question that I had here. If you do have questions about this topic, please feel free to contact our office. The phone number is 978-624-3000. David would be happy to talk to you about any questions that you have or your personal financial situation. Again, if you'd like to join us for upcoming webinars, you can find those on our website at stonehearthcapital.com. And we hope you all have a wonderful rest of the day. Thanks so much.
Thank you. Bye-bye.